I'm your host, Corey Naycock, and today we're exploring questions that are at the top of everyone's mind. How long will inflation last? Can we avoid a recession? Russia, Ukraine, China, how will geopolitical risk impact the economy? Will more banks collapse? And what does it all mean? This is why Avenue has partnered with UCLA Anderson Forecast, an organization with a 70-year history of producing some of the most accurate forecasts for our country. Together, with Avenue's 40 years of experience in serving state and local governments, we hope to provide you with meaningful insight into these critical topics. Now, it is with great pleasure that I introduce Dr. Jerry Nicholsberg, Director of UCLA Anderson Forecast, Mark Bryson, Avenue Senior Economic Analyst, and Fran Mancia, Avenue's Vice President of Government Relations. With a special thanks, welcome, gentlemen, and thank you all for being here. With a special thanks for Fran Mancia being here today. He just had shoulder surgery, and he is plain wounded today. So thank you so much for being with us. And a quick reminder before we begin, please refer to your briefing doc that was sent to you in your reminder emails for more info about our panelists and both organizations. We also invite you to use our chat feature to ask any questions you have along the way. We'll do our very best to get to all of them. Now, we've got a lot of ground to cover, so let's dive in. I'd like to turn it over to Fran Mancia for his political and federal budget update.
Great.
Fran?
Thank you, Corrine, and thank you, everyone, for joining us. It's a pleasure to be with you. This is the part of the conversation today that we had the most trouble talking about. What are we talking about on the federal and the budgetary level? There's so many things happening all at once. We saw an interest rate increase yesterday. There's a lot of political drama taking place between the two parties. The Democrats have a budget out. Republicans should come out with a budget by April 15th at the federal level, but that looks like it may not take place till May. And so there's really not a lot of work that's been done there. And other things have sort of been at the forefront. The Democrats would like to start taxing the top 1% tax earners. The Republicans are opposed to that. There seems to be some agreement around Medicare and Social Security that they need to be protected. But then where do the cuts come if we're going to try to come up with a budget ceiling? So that's stuff to still be determined. The Democrats are very focused on environment, healthcare, things of that nature. The Republicans have been conversing about perhaps cuts to social services and the EPA, electric vehicle funding. So with a lot of this drama that's going on, what we're really going to try to do is just cut through some of this noise and talk about the issues that are before us. And again, in future sessions, as we learn more at the federal level, we'll have updates politically in terms of federal legislation and the budgets. But with that as a backdrop, I'll hand it back to Corrine real quickly. Thank you.
Thank you for setting up the entire program, Fran. So that let's turn it over to Jerry. So Jerry is the expert in inflation and recession and the economy. So Jerry, what are you seeing?
That's an open-ended question, but thank you to Avenue for inviting us from UCLA back to the webinar. It's a pleasure to be with our friends from Avenue. Inflation, recession, those are the worries that we have. And I think it's important to realize that we are in somewhat uncharted waters, that we have just been through a pandemic-induced recession, and the economy has shifted. The structure of the economy is different than it was 5 years ago. And that means that as we look at past data and trying to extrapolate and understand what might be coming down the road, it's just much less reliable than it was, again, 5 years ago. And so we have to look at the data carefully and understand the uncertainty. So let's go to inflation. Inflation has been high, it's been sticky, it's been coming down and actually coming down very rapidly. If one were to look at the consumer price index, it has fallen over the last 3 months, so the average for that, on an annual rate to 4%. But the year over year is 6.0%. So we're talking about an inflation rate that's 6%, but it's come down to 4%, and it's kind of steadily come down. And the big issue with inflation, at least as it's measured with the metrics, is in shelter costs, in rents. And a lot of that reflects what happened in rents 6 months to 12 months ago, rather than what's happening today. So we're expecting it to continue to come down. But having said that, the Federal Reserve, who has a mandate to fight against inflation through monetary policy, still sees these inflation rates much higher than the 2 to 3% that they are looking for. And so yesterday they increased the federal funds rate by a quarter a point, 25 basis points. But at the same time, they indicated they might be done or close to done to increasing rates. And they're concerned about financial stability. So they're watching to see, is there any contagion in the failure of Signature Bank, of Silicon Valley Bank, of Credit Suisse? And so look for them to be monitoring that carefully. And we may be close to, if not at the end of the interest rate increases, particularly if we see further declines in inflation. The impact that we are seeing is differential across the country. So those higher interest rates are affecting housing starts more in places like Arizona and Utah and the Carolinas than in California and in Texas. But that means decreased demand for building materials, for appliances, for home furnishings. And so that's affecting manufacturing to the extent that it is in the US, and a lot of it is in the Midwest and in the South. So we're seeing differential effects across the country. And that feeds back into sales taxes, for example. And so with that, I'm wondering what my colleagues at Avenue are seeing in terms of sales taxes and differentials in that regard.
Before we jump into sales tax, Jerry, a couple of questions have popped up. So, how do you view the recent financial crisis at Silicon Valley Bank and Credit Suisse, and what implications might they have for a broader financial system? And are there any lessons to be learned from it?
Okay, so that's three questions. Happy to delve into it. I want to, first comment that there's a lot more to be learned, and so there's a lot of speculation going on. But what we do know is that the events at Silicon Valley Bank and Signature Bank were runs on the bank. The banking system has changed quite a bit since the last time we had runs on a bank. Now it can be done with a smartphone. And so we saw billions of dollars, tens of billions of dollars come out of Silicon Valley Bank very quickly. And that was not possible in the past. The federal government stepped in and guaranteed all the deposits at Silicon Valley Bank. And they have indicated that they're guaranteeing all the deposits at all the banks. They haven't really said that, but they really do mean that. And that means that if one has deposits more than $250,000 in value at a bank, there's no need to take it out. It's guaranteed. That helps stop runs on banks. The second thing that we know is that there is nervousness in the financial sector about risk. And so lending standards are going to tighten. And as they tighten, that's going to affect home purchases. We're not seeing it in interest rate increases, only in financial institutions being less willing to take more default risk. So better credit is going to be required. And similarly with business investment. So those are the things that we know. What we don't know, which is your third question, is to what extent is the failure of these banks an indication of something going on in the non-bank financial sector, which is quite large and relatively opaque because it has light regulation, unlike commercial banks, that would impact our banking system. And what we don't know is, vis-a-vis Credit Suisse, what's happening abroad and how that might affect our banking system. So those are the unknowns. That's the real uncertainty that we have right now. So we know credit standards are going to be tighter. We know there's going to be less lending, but we don't know if there's systemic risk in the non-bank financial sector.
Great. Thank you so much for answering all three. So you had mentioned in your opening about inflation and recession that there's also some regional impacts. I'd like to turn it over to Mark for a regional perspective. What are you seeing at a local level? Are people still traveling and spending at a local level?
I think it pretty much reinforces. First, I'd like to say I'm honored today to share the stage with Dr. Jerry Nicholasberg of the Anderson Forecast and my colleague, Fran Mancha, our government relations vice president, and say hi to all our clients and friends that are out there. Spending it remains pretty strong in California, where I specialize, with a couple of exceptions. Jerry mentioned wholesale and retail building materials. You have higher interest rates at work. There's also what I would call the post-work-at-home migration. There was a lot of remodeling and renovation that was going on associated with that. We're past that now, and we're seeing some slowdowns, especially on the retail construction material side. But I did notice this morning that new residential construction is up 9.8% for February. So we may be turning the corner on that. Gary could probably speak to that better than I can. The other thing I've noticed is some change in consumption of high-end luxury items. Some of our like Maserati dealerships or auctions of art and that sort of thing, we're seeing some declines there. And the final thing that we're seeing is used auto sales, which is partially higher impact of higher interest rates, and a lot due to demand for electric and hybrid technologies.
And I think just to add a little bit to Mark's comment, I think across the country, you're going to see slight variations based on the business spaces and places, but clearly travel is at full steam ahead, and we're seeing a flattening, but not necessarily a decline. And people are still out there traveling and spending money, which is certainly a positive for sales tax revenue.
Yeah, a couple macro observations in this regard. One is that an important component of the increase in prices that we observe in the inflation metrics is airline tickets. Mm-hmm. And everyone who's traveled knows that, but that's not a sustainable increase. So we expect that component to not be as important as we go forward. It doesn't mean ticket prices are coming down, just that the increases, which is what inflation is, will not be continuing. And, with respect to the numbers that Mark just relayed on housing in California, California has a lot of new housing products, such as ADUs and duplexes in formerly single-family zoned neighborhoods. That has spurred residential construction in California and has resulted in the state bucking the trend nationwide to less housing construction. So that's a differential that we do see indeed. Interest rates are having an impact, but not as much here as elsewhere.
So we had another question come in. And I apologize, we had a little bit of feedback there. So if you're experiencing feedback, our apologies. How can governments... So, Fran, I think this one, well, I'm going to throw it out to the group.
Okay.
How can governments prepare for potential changes in revenue and adjust their budgets accordingly?
Well, I think that's a great question. And I think it's top of mind for cities across the country. Really, our philosophy has been to budget as conservatively as possible. And that's been our message going back even into the end of 2022. Many states have started to build bigger reserves at the state level and at the city and local level, putting more money in the rainy day funds to stockpile for the anticipated changes ahead. I think it's imperative to be conservative in budgeting, forecasting. I think it's primary because there is so much uncertainty, as Jerry and Mark have already spoken about. To me, that's the number one thing, but then also to get as much advice as you can from others. So, for example, looking at it internally or looking to groups such as ours in this call today to give micro and macro perspectives. We're always happy to help provide forecasts or perspectives. Continually tweak your budget assumptions that go into how you estimate your revenue. It will change. We internally meet on a bi-weekly to a monthly basis to look at all the changes. Even in preparation for today, we had so many changes in what were happening as we prepared to talk with all of you today. So I think those are the key things.
Thank you. Jerry, do you have anything to add to that?
I don't have a lot to add to that. I think Fran is spot on with that. State and local governments have asymmetric objectives, right? And what I mean by that is that it's much easier to add programs if you get more revenue than you expected than to cut programs if you get less revenue. So at UCLA, we make forecasts of the most likely outcome. But for state and local governments, as Fran said, one should be more conservative than that and have a forecast that shades to the conservative, to the lower side, because of that asymmetry in the pain or pleasure that accrues to having reality be above or below your forecast.
Great, thank you for that. Mark, I think this one's in your area, and Fran, are there any recent or upcoming policy changes that address the impact that e-commerce is having on sales tax revenue?
Yeah, maybe I'll just jump in first, if I may. I think the biggest one was clearly the Wayfair decision, which was implemented in April of 2020. It required online sellers who were selling in another state to collect the sales or use tax on the front end versus voluntary compliance. If you purchase something from Amazon or a third-party seller, let's be honest, most of us were not voluntarily complying and remitting those taxes. I think for cities across the nation, that revenue number has been really, really big. It blew away the estimates that we had and others had of how much might potentially come in. And I think it really helped stem the tide, especially during the pandemic when people are shopping at home. It really helps save cities, in my mind, in terms of revenue loss, because businesses on the retail side were closed down. It's been a significant boost, and I think that plays across the country. State of Louisiana is an example where we work helping the state collect and the e-commerce money. It's over $1 billion of e-commerce transaction that have come through there in the last year and a half or so. So to me, the Wayfair has been a very big part of it. Again, no more voluntary compliance. If you buy something online, say you're buying it through Amazon, they're going to collect the local tax on the front end before you receive your items, whereas before you would have voluntarily submitted. So I think it's a big deal.
I don't hear any sound.
Sorry, thank you for that. Mark, are there any economic indicators that state and local governments can monitor to help them better anticipate changes in retail sales and sales tax revenue?
Yeah, later in our presentation, I think Jerry's going to talk about employment, and that's one of the things you can monitor in a larger jurisdiction, especially like LA County or any large area with a large population. Changes in employment tend to correlate fairly well with changes in sales tax revenue. That becomes problematic with smaller, mid-sized and smaller communities. So what we've found that works best is basically per capita income plus something we call capture, which would be sales tax revenue that you get from non-residents, visitors, tourists, commuters, that sort of thing. And so when you look at changes in per capita income plus capture, that tends to correlate very well with changes in growth in your sales tax revenue.
And I'm curious, are there certain areas of the country that are more vulnerable right now?
I think that's a better question for Jerry to address.
Do you see are different areas more vulnerable to drops in sales tax revenue? by region of the country?
So I'm sure that that's the case, but let me address one part of that because that's a very complicated question. And as Mark said, looking at where you have growth in employment and growth in income is important, or where you had a shrinkage. So if we do go into a recession, that's going to be different in different states. And some states are going to see more contraction than others. For example, states that are heavily dependent on the manufacturing of automobiles will be hit hardest, and so that income will go down. One aspect that's differentially important is the return of Chinese tourists. And so that will increase retail sales, but only in the places where those tourists tend to go. And that is only about 4 cities, 2 in California, San Francisco and Los Angeles, Las Vegas, and New York. And so there you get, even if there is a recession in 2023, you get an increase in retail sales that will moderate any decrease because of a decrease in income. So I think those are the factors that you have to look at kind of across the country as to how 2023 unfolds with the weakening economy, increases in interest rates, and the impact thereof.
Yeah, and to add to Jerry's comment, the cities he mentioned have certainly had a hard time rebounding from the pandemic closed downs. As we look at cities across the country, they've been the slowest to come back to previous levels and still have not reached them in many cases. So I think Jerry's spot on with his comment.
All right. Well, thank you. So we had moved into retail and sales tax, but I want to jump back to inflation and recession because Jerry, you just said the R word twice. You said recession, and so everyone wants to know: Are we in one? Can we avoid it? Is it coming? Wait, can you talk about the R word?
Sure. So, first question: are we in one? Decidedly no. Recessions are about idle resources. So we talk about recessions as being 2 quarters of negative GDP, but that's just a kind of rule of thumb. But it doesn't really get at to what recessions are. Recessions are increased unemployment, so idle labor, and increased or decreased use of capital, so that is capacity utilization going down in factories and shops, around the country. We have none of that. We have very strong labor markets. We have very low, historically low unemployment rates. People are working, their incomes are going up. That's not a recession. Capacity utilization has been relatively constant, even as companies have been adding more and more capital. So there's not idle capital. So we're decidedly not in a recession. Will we go into a recession in 2023? Well, first, will we go into a recession? Eventually, yes. So, those who call a recession every year are bound to be right, just like a broken clock is bound to be right twice a day. But will we be in a recession in 2023? It really depends on policy, because we don't see any sectors across the US that are out of balance and that are looking at a correction. But interest rate policy affects interest rate sensitive sectors. So the ones I mentioned earlier: durable goods manufacturing, housing, and autos. If those sectors contract sufficiently, and there is then propagation of that contraction to other sectors, we get a recession. So if the Federal Reserve increases interest rates aggressively through the first half of this year, as at least in the fall of 2022 they said they were going to do, then I think you can expect a mild recession. If they take a pause, as they're now indicating they might do, then I think you can expect slowing growth, but not a recession. And so in our forecast, we have 2 scenarios based on policy. We don't know what policy the Fed's going to follow. To be fair, neither do they. And so that's something to watch how aggressive is the Fed going to be in terms of fighting inflation rather than trying to hit that middle ground between inflation that's coming down slowly and an economy that is still growing.
So this may be a good time for us to transition into labor markets, Jerry. And I have a question. I know you're going to cover the topic of labor markets, but if the Fed continues to increase the interest rate, will it lead to higher unemployment?
The increase in interest rates invariably leads to higher unemployment. Right now, we're not seeing that, and recall that I said, the past data is not as useful as it once was. We're not seeing it because we have many sectors that are doing very well, and so increases in interest rates may result in some layoffs in part of the economy, but we have other parts of the economy that are absorbing those workers, and so far we haven't seen this, but eventually, with high enough interest rates, we will see increased unemployment.
Got it. Thank you. And Jerry, can you talk about the labor markets at this point? Can you share your insight?
Right. So, again, we have changed structure to our economy, and we see growth in over the last couple of years in logistics, and you all have talked about that with online shopping. We've seen growth in construction. We've seen growth in technology, in manufacturing. Here in California, manufacturing employment is the highest it's been since prior to the Great Recession. So we're seeing lots of growth across the economy. That has led to historically low unemployment rates. And in California, in the coastal areas, which is where most of the jobs are, you see unemployment rates that are below 3%, historically low unemployment rates. So we have a very tight labor market. And one of the things that's happened that has created this tight labor market is that in 2020, we had millions of boomers retired, and they didn't come back to the labor market. So we have a smaller labor force now, and absent significant immigration, we have lower potential GDP, but that means that firms are competing for fewer workers. We've also seen a shift in demand. So those logistics jobs and those construction jobs have drawn workers away from leisure and hospitality. And I think everyone has noticed that in the restaurant space, there are fewer people working, right? And so we have tight labor markets. One of the indicators that we follow is the claims for new unemployment insurance, which is an indicator of layoffs. And they're historically low. They're below 200,000. And kind of normal is about 225,000. So labor markets are tight. Even if interest rates cause labor markets to loosen up a bit, there's a long way to go before the unemployment rate is something that one, really should worry about.
Thank you. So what are your thoughts on the return to the office movement? How is that affecting things, the labor market?
So with respect to return to the office, we're seeing companies deciding that for many of the tasks that they have for their employees, those employees need to be in the office at least somewhat. And so that's moving to a kind of hybrid model where there is some work that can be done away from the office, but you have to be in the office, which doesn't mean that you have to live in the city core to avoid commutes, because coming in 2 to 3 days a week means you can live a little further afield, but you can't live 6 hours by air away. Those jobs that are fully remote right now seem to be diminishing. And there are two important aspects to this. I guess the most important is if you're working and coming into the office, your competition is the labor force in the city or community that you live in. If you're working fully remote, your competition is worldwide. And if you're fully remote and you are in the mountains of Colorado, from your employer's perspective, you could be in Hyderabad, India. It doesn't really matter. And that means that the pressure on you as a fully remote worker is going to be on your wages and on your employment security. And so that's going to lead folks to want to be back in the office. And then the third aspect of this is that we have millennials and Gen Zs coming into the market. They need mentoring, they need networking, they need a social life, or they want a social life, maybe both. Those don't happen living, in a cabin in the mountains. And so they're going to want to be close to their employment. So all of those say that we're still in transition. Exactly how it shakes out, we don't know. But certainly the idea that we're all going to be working from home is an idea that's sort of going away.
And just to add, I think we're seeing that in some communities that we work with and study across the country in terms of their restaurants and entertainment hubs, where a lot of the cities I'm thinking of in particular have very reliant on lunch and dinner people during their lunchtime, then they commute out of the community. We're starting to see those revenues start to increase again and start to pick up. So there's signs that people being back at work are having a positive impact at the local level in terms of the sales tax that's generated by their consumption being in communities. I think all of us are probably seeing in most cities across the country, traffic is certainly back up as you go into your cities and communities. I work in Sacramento, California, so when I'm there, certainly the traffic is there. A lot of it has to do with the government workers or in a situation in the capital where they're required to be there. We're also seeing more and more jurisdictions, cities are having hybrid approaches where they're expecting workers to be in some days a week, and that's varying from city to city, of course. But all those indicators seem to be showing that back to work is having a positive impact on the local tax side.
Is that bringing a return to brick and mortar? A higher demand for more services?
Well, I think that's a great question. I think brick and mortar really has two different pieces. One is experiential. So that means going somewhere for a movie or for dinner or a show, things of that nature, where you're driving somewhere to do something. And then there's the general retail and the necessity retail, where you might go to a mall or to shop because that's convenient to do your grocery shopping for essential things. We're seeing both sides doing very well. In general terms, they're doing very well. And then a lot of people were wondering, coming out of the pandemic, with e-commerce taking off and being such a big part, would that decline and have an impact as retail came back? What we're seeing is e-commerce is holding on fairly well, slightly down, and Mark can certainly talk to this as well, but we're seeing retail growing. So it really comes down to being very strategic in what type of economic retail that you want to have in your community. And Mark, maybe you can jump in on that as well.
Well, to reinforce what you said, pre-pandemic, we saw people buying less stuff and spending more money on experiential items and also digital content, which isn't subject to sales tax. Then during the pandemic, there was the shift back to goods and especially buying it online, e-commerce. And now we're seeing the shift back to the pre-pandemic trend, which is a little, less towards stuff, more money being spent on services and digital content again. But as you said, e-commerce still remains fairly strong. We're just not seeing the double-digit, 12%, 16% annual growth. Now we're seeing more like 4-6% annual growth. So it's just kind of normalizing, I think.
Mm-hmm.
Yeah, I think there are two factors that are really quite interesting here. One is that as people move to the suburbs, particularly because of hybrid work or millennials who are now starting families, you get a shift in where they're buying goods from the city center to the suburban communities that they're moving to, and in particular new housing developments. And so we're actually seeing a growth in retail construction now. The second is, and this comes from research from Professor Nicholas Bloom at Stanford, is that the pattern of traffic to to places like golf courses, amusement parks, and the like has changed. It used to be predominantly a weekend or 3-day weekend kind of traffic. Now there's a lot more midweek. And so that's going to change where people are spending money and when they're spending money. And you know, how that plays out remains to be seen. Now, some of that may be those millions of boomers who've retired, but also if you're on a hybrid schedule, you can be going to the golf course or to the mall during the day when you would otherwise normally be in the office, because you're going to be working later in the day and into the evening. So we're seeing some change there, and that should affect local sales taxes and affect what's happening in retail.
So you said that retail construction is up. So what about housing construction? And what about office construction? That I still see a lot of empty offices, you know, that haven't completely refilled. So what's the dynamic there?
The short answer is office construction is dead in the water and will be for some time. There is excess office space, as you pointed out, and there are leases that are being renegotiated, and no one really knows how much space is going to be demanded for a hybrid model. So investment in new office space is risky. And so we're seeing, you know, very little office construction. But in a new housing development, you need new retail. And we're also seeing the conversion of existing retail to experiential retail. That's something that Mark was talking about. That will attract people back for the social aspect of retail.
Yeah, and just to add to what Jerry said, and a good example is Best Buy stores are large closures across the country of those locations. And as I read articles and talk to folks, there's a demand for that space to repurpose it, to Jerry's point, whether it's experiential, maybe a Planet Hollywood or Planet One gym, for example, or stores like TJ Maxx and Ross stores and Nordstrom Racks. They're very eager to repurpose the spaces from these closures. So the retail real estate folks are saying that space will be gobbled up quickly. Then the question becomes, from a city's perspective, which one of those stores might generate the best revenues if you have some input. Certainly a Nordstrom Rack or TJ Maxx will generate more revenue than perhaps a health club, because there's only certain things you can tax there. So it's an interesting area, and that's easier to repurpose than to rebuild. And so we're seeing a trend of that taking place in many places.
That is a very interesting point. Thank you. So let's transition to, I had mentioned earlier, like the geopolitical risk. We've got Russia and Ukraine and China and Taiwan, and so many things going on in the world. Jerry, can you give us your outlook on the geopolitical happenings in the world and how it affects our economy?
I can give you my perspective. There's much in the geopolitical world that is both risky and unknown. So let's start with Europe. That's where you started, Russia's invasion of Ukraine. That war looks like it's kind of grinding to a World War I sort of stalemate, but it remains to be seen. There's the spring and summer offensives coming up on both sides. In terms of the economy, it's having less and less of an impact. The European economies are adjusting to buying fewer energy resources from Russia. The initial impact on food supplies seems to be over with. The price of wheat is below pre-invasion wheat prices. And so in that respect, the world economy seems to have been moving along. It has had an impact on the demand for defense goods or for military materiel. That differentially impacts the US. So that is increased demand for manufactured goods from California, from Texas, from Connecticut, and a few other places in the US, Georgia, less so other parts of the US. So it's going to mitigate against any slowdown in the economy, say here in California or in Texas, because you have an increased demand that is not interest sensitive. The geopolitical risk, will the war become wider than just Russia's invasion of Ukraine? We don't know. We think not, but mistakes are made in this sphere. So that is open. China, Taiwan, I think there's less risk today than there was in terms of an actual invasion. But China's current position and the US current position means increased decoupling of these two economies. And so that's going to be disruptive in one sense, but also will lead to higher goods prices as there's a movement of the supply chain away from a country where we're having a lot of political tensions to countries that we have fewer tensions with, such as Mexico, Canada, Vietnam. So we're seeing a change there, but that change is going to lead to higher prices. So I don't think those risks are huge. One place to look for potential geopolitical risks is India and Pakistan. They're both nuclear powers. They've fought a number of wars in the past, and both countries are experiencing difficulties internally, domestic difficulties. So we should keep our eye on that as well.
All right, thank you. So all of this affects global trade. So a question for all of you, what strategies or how can a state and local government consider preparing for a potential disruption in the future? Because any of these things could happen. You know, there's so many different variables out there.
I mean, maybe to kick it off, I think it kind of goes back to the original comments we made about being very conservative in how you budget. I think it's really important to be cautious about spending, making sure you're spending on ongoing programs. Don't spend one-time money on ongoing programs, so you might build a bigger deficit. I think being cautious in terms of the priorities and keeping things simple and trying not to get caught up in a lot of the noise, because things are changing so rapidly. You start falling down tracks. It's not to belittle the challenges that are before us, because they're changing every day, but keeping it simple, keeping it conservative, with an eye on the prize of providing good quality services. It sounds altruistic, but I think that's so important.
And also there's the concept of expect the worst, hope for the best. And one of the things that I've seen with sales tax revenue, I've seen the effects of wildfires on certain communities like Santa Rosa, California. I've seen the effect of hurricanes on the city of Houston and others. And so consider that, these things can happen and can have serious impacts to your revenues, and in fact create a bunch of expenses that maybe you weren't anticipating. So it just kind of reinforces what Fran said about being conservative and thinking about variability and volatility.
Climate change certainly is a huge impact on everything. And in fact, Jerry, isn't UCLA Anderson Forecast bringing on an economist just to focus on climate change and the impacts?
We are, and we've completed the hiring. This is an economist who's coming to us from Cornell, and her work thus far has been on wildfires. And she will be spending her time researching both the economic impact of climate change, but also probabilistically when it will happen and what that will mean for the trajectory of the California economy. And of course, we can extrapolate from that to other parts of the country and other kinds of climate-induced disasters that Mark was referring to. So we think this is an important part of looking forward, and that business as well as state and local governments should be paying a lot of attention to it. Back in, say, 2018, we were talking about climate change, and we were saying, well, in 2030 or 2035, here's what we expect. That seems like a long way away. But 2030 is 7 years away. It's not a long way away anymore. And so planning for that and really thinking about the what if scenarios, I think is really important. And that's why we're dedicating resources to have an economist who's just focusing on that for our forecast activity.
That is great. That's a whole segment by itself, I am sure.
Yeah, and I think from our local perspective and in collaboration with our partner at UCLA, as we work on our assumptions with local revenues, we start to anticipate some of those things. What would there be an increase in demand for timber or building materials wholesale as a broad base? As these frequencies occur, and we have some historical data based on that, that'll be factored into our forecast at the local level as well, because different things, supplies will become priorities. Then you worry about supply chains and things we talked about. So it has to become a part of our assumption process going forward, and it's continually changing for sure.
Yeah, when you think about what was it, Hurricane Ida that went through South Florida,
right.
There's more than 100,000 homes that need rebuilding. And that building demand was not there prior to the hurricane. So that, as Fran just pointed out, that affects sales tax, but it also affects the prices of building materials.
Right. And then we have to look at
the price of labor.
Yeah.
And insurance.
Then it ties into property taxes and other types of taxes as well. So it just continues to morph out in terms of impact.
Mm-hmm.
Well, thank you. So we've had another question come in, and I invite you guys to also ask each other questions, because I know you often do. I'm on the call beforehand, and I know there's lots of dialogue and questions amongst each other. But what is the short-term and long-term impact of the current inflationary pressures on the economy?
The short and long-term impact. So in the short term, well, before I say that, increases in prices, which is inflation. So inflation is across the board increases in prices. Right? So if the price of oil goes up and other prices go down, that's not inflation. It's all prices going up. That has a couple of effects. One is people on fixed incomes find that the purchasing power of their incomes goes down. So they're going to buy less, and that's a decrease in demand in the economy. The second is that it decreases the value of debt, which is a benefit to the borrower, but is exactly the opposite for the lender. And so what you see in inflationary times is lenders try and build in increases in interest rates to cover the loss in value of their loans. And so we get higher interest rates. They're in anticipation of more inflation. So that's really the short-term impact. Benefits some, does not benefit others. It's really a transfer of income and wealth. The long-term impact is that it erodes our financial institutions. And so it has a negative long-term impact. Things adjust, but controlling inflation tends to be very hard, particularly when it becomes more than a few percent. And if it goes over 10%, it ends up being fairly difficult. So that's the longer-term impact. What we're seeing in the U.S. now is that all of the expectations is for inflation to be somewhere between 2 and 3% in the long run. And that is something that is both manageable and actually desirable, because it allows some more flexibility in prices and wages. So the long run outlook for inflation in the US is actually pretty good.
Real earnings, I'm sorry, go ahead, Corey.
Oh, go ahead, Mark.
Real earnings is something I actually track, and they've been declining. Like October minus 2.8%, November minus 1.9%, December minus 1.7%, January minus 1.8%, February minus 1.3%. So wages, real wages, when you adjust for inflation, are not keeping up with inflation, which reduces buying powers. Jerry mentioned especially impacts people on a fixed income. And so that is going to be a bit of a drag on retail consumption in 2023 and possibly
Yeah,
beyond.
and there you have a real differential across communities, right, Mark? Because if you have a larger percentage of your population is renting, then they're going to be more impacted by inflation as it increases rents than if you have a larger percentage of your population that are homeowners and their mortgage payments are not changing even though rents are going up.
Absolutely.
What are you guys seeing on a local level for that? Is it across the board that wages aren't keeping up with it, or is it by industry? Is it just, is it
That's a
by
national
region?
figures that I quoted were national figures. Everything varies by region and, geography, demographics, income is a big differentiator in terms of how recessionary forces impact you. So when you ask those questions, it's a little tough because the answer is, of course, it varies by region and by income and many things by population and demographics. So in California, we're seeing places that are more dependent on international tourism and travel, more entertainment oriented, being impacted in different ways than smaller, say, ag communities in the Central Valley, that sort of thing. So there are always those differences. How it's all going to play out is actually pretty complicated, and not sure I can tell you that.
It would require some crystal ball, I am sure.
Always.
Well, we are approaching the top of the hour, so thank you to our panelists for sharing their expertise and giving us a great presentation, always insightful. And thank you to our audience for investing the time in us today. We loved having you and appreciate your thoughtful questions. And a special thanks to the crew behind the scenes at Avenue who helped put this together. We'll be sending a follow-up email with a link to the webinar so you can rewatch or share with a colleague who may have missed it, and wish you a great rest of your day. Look forward to connecting with you soon. Thank you.
Thank you.